Welcome to Smart Project Concepts. We finally made it. What I call Smart Project Concepts is this is a university grade education in Forex. What you're going to see, there's going to be a bunch of webinars, a bunch of videos down below. All these videos, they are recorded in a virtual class setting. It's like I'm here in the classroom and you're on the other end watching how we present things, present simple concepts on the whiteboard in a virtual class setting. Now, I know a lot of you members are older members of Market Fluidity and you're just getting into Smart Project Concepts watching this. There's nothing new. Some concepts are newer, but some concepts are even more broken down for a better understanding. For people who are new, I welcome you all to the best education in Forex when it comes towards simplicity. As new traders, there are a couple of things that happen, right? Psychologically, things go wrong. Mentally, things go wrong. You go into over trading, over risking. But once you truly understand what price is really doing, where market is really moving, how candles are really printing, all these things go away, which is why there are a couple things that we really focus on a lot in Market Fluidity and now coming into Smart Project Concepts. Risk management. Managing risk, keeping your losses small and making sure your winners comparatively to your losses, they seem bigger. Adding risk back to the trade. Let's say you manage the risk. Giving your trades a second chance by keeping the same bias. Adding positions back to a winning trade. All these things, they go hand in hand. And technically, if you really truly understand how price is moving, why is it moving, when there's volume, when there's not volume, psychologically, your whole perception about trading gets better. So take it slow. There's a lot of information. There's a lot of knowledge in this section and the Market Fluidity section. So what I'm going to say is if you are new, if you've maybe been in the Forex market for about a month or 2 months, I would highly recommend to go through the Unlearn and Relearn section in Market Fluidity. Then come into Smart Project Concepts. In future, obviously we have Slack, our community, and also at the same time, now we're going to be not doing any more webinars. Of course, there's going to be simulation webinars every bi-weekly, but mostly what we're going to focus on are going to be virtual classes, like different topics that we can go over in a virtual class setting. So what you're going to see in the future now is this list. It's going to continue to grow and grow and grow because I think having a virtual class setting is the best form of learning. To be honest, I learned that way much more better than just a webinar. So again, congratulations, you've enrolled into one of the best education platforms on the internet right now about Forex. So take it slow, give it time. Don't expect results in the next month, 2 months, 3 months. Give it at least 6 months to a year, following these concepts slowly and gradually, building a trading plan, refining your trading plan, and you're going to see a light at the end. This has happened to a lot of people. This is still happening to a lot of people, and a lot of new people are going to see that light, are going to see that light of profitability. That's what I call it, right? It's going to happen. So if you think it's not happening for you now, you just got to dial down on your risk, on your trading plan, on the time that you're going to trade, how you're going to focus on all that stuff. So it's game time. Good luck and take care. What's up, everybody? Welcome. Now today, this is going to be the most important section, right? So we're going to talk about risk management. Now, a lot of you people, a lot of you guys already know about risk management. A lot of you guys already know how to manage risk, what sort of risk you're going to use, what sort of if that's going to be, you're going to use a static risk, dynamic risk, where you're going to put your stop loss and stuff like that. So we're going to go over all of that. Now, before we start, this section is going to be divided into 3 parts. The first part is going to be about different types of risk or different types of stop losses that you want to use. The first one is always going to be the static risk. The second one is going to be the dynamic risk, right? So these are very important, static risk and dynamic risk. Now, the second part is going to be about where exactly to put your stop losses and how you can use static risk and dynamic risk in actually putting your stop losses, right? So let's say you're going to have a stop loss, and now you have to identify whether you're going to use a static risk or a dynamic risk. Now, before we begin, dynamic risk is a little bit complicated. It needs a little bit of a practice and a little bit of intuition trading. Intuition trading is basically when you're anticipating a certain move or you're anticipating certain, a retracement or liquidity grab. So that's where you're using dynamic risk. So we're going to go over that too. Now, the third part is going to be the most important part. The third part is going to be how to reduce your losses, right? This is the only way that you can come out of that break-even stage, because a lot of people get stuck in the break-even stage, and the only way to get out of that break-even stage is to understand how to reduce your losses. So we're going to go over all of that. Let's get into it. Okay, first, we're going to talk about static risk. Now, whenever we're talking about risk, we are basically talking about risk in terms of 1% to 2% risk, right? So static risk is going to be, so let's say we donate static risk with SR. Static risk is, let's say if you're a trader and you're trading and you identify an opportunity, you're going to use, let's say, 1% risk. That's about it. That's the only thing you're going to use, 1% risk. That's it. Now, next is, let's say you have a $1,000 account, you have $1,000 account, and you want to risk 1%. Now, what's 1% of $1,000? That's around $10, right? So that's around $10. So you're going to risk $10 in the anticipation that a trade goes your way. Very, very basic stuff, nothing complicated, nothing really advanced at this point right here. Simple, you got $1,000, you're risking 1%, and your risk is going to be total $10. Now, let's say if you're risking 2%, so your risk right here is going to be around $20, right? Now, what does this relate to in lot size? Now, listen, how to calculate lot sizes, how to calculate your risk and pips in terms of lot sizes, it's already explained in our risk management section in market fluidity, right? So go over that. This one right here, we're going to keep it very simple, and we're going to go over dynamic risk. Now, static risk, let's say you have a candle, and the candle is pushing bullish at this point, and let's say we're at support, and you want to take a buy at this point, right? So if you take a buy, you can take a buy right over here, you got your little buy over here, and the next candle goes up. Your total risk at this point was, let's say, 1%, right? So you took one position. Let's say this position could be, 10-cent lot. This position could be $1 lot. This position could be, let's say, your 4 lots here as well. So you just took one position, price went in profits. If price would have came down, it would have hit your stop loss, and you would have lost exactly how much you would have risked. Right, so that's static risk. Very, very simple, nothing complicated, very, very basic stuff. Now, I know a lot of you people have some questions. We're going to keep those questions to ourselves, because as we go along, all those questions are going to be answered. Now, next we're going to talk about is going to be dynamic risk. Now, dynamic risk is where things get a little bit complicated, a little bit advanced, but not so advanced, right? So let's talk about this right here. Now, dynamic risk, we're going to denote this by DR, okay? Now, let's say you're a trader, and you're very disciplined. You don't want to risk a whole lot of money at this point. You're very, very risk averse at this point. So let's say you're going to go with the total risk that you're going to use is going to be 1%, right? Let's say your total risk is going to be 1%. If your total risk is 1% and you don't want to execute this whole 1%, it's always a good idea to break this down into 2 positions, 3 positions, 4 positions, right? So sometimes what guys do is they'll break this down to 0.5% risk, 0.5 and 0.5, right? Now you got your 2 positions. One position you can enter first, second position you can enter later. Now, sometimes when you enter the first position, and now you want to wait to enter the second position, price may already move. When price already moves, you're only stuck with just one position, and you had no opportunity to add that next position. Now, that has sometimes happened to me as well, right? If I would say a price has to go down, and I would take a sell, and then I would say that I'm going to enter another sell as price retraces. Instead of retracing, prices continues moving, and I'm just left with just one position. That's very, very normal. That comes with using dynamic risk. Now, for example, let's say we have a 2 lot, right? Let's say your total risk, based on your stop loss, based on your the amount that you're willing to risk, you're going to use 2 lots at this point. Now, instead of using 2 lots, I think it's going to be a good idea to maybe break this down into 2 1 lots. Wouldn't that make sense? Like if you're on a setup which you're not unsure about, or which you're not sure about, you may want to break down your 2 lot into 2 1 lots. Or sometimes, we get a setup which is risky. Let's say if you're not that confident in a setup, and you may want to break this down into 4 positions, and that may be 4 0.5 lots. You have 0.5 and you have 0.5. You have 4 0.5 lots. You may break down positions in 4 0.5 lots, and that's what's going to constitute dynamic risk. Now, to break it all down, static risk is where you are using your complete risk, right? And always remember, whenever you're using static risk, you have to manage risk. So we're going to talk about managing risk in the third section of this virtual class. You have to manage risk if you're using static risk. If you're using dynamic risk, you're basically managing risk even before when you're taking the trade, right? So that's the difference. Dynamic risk is where you break down your full risk into multiple positions. Static risk is where you're using the entire one risk. Let's say this is 1%. Static risk is where you're using your complete 1%. Okay? Very basic stuff, nothing complicated. Let's move over to part 2, which is going to be applying static and dynamic risk based on candle conformations. All right. Let's say we have a trend that's coming down. We're going to come up, create resistance, come down. We're going to come up, create resistance, and come down, right? So we have a trend that's moving down. So we have a bearish trend at this point. So whenever we have bearish trend, what are we looking at this point? We're looking at resistances to form, because once we see a resistance forming, then we can identify that, okay, since we have a resistance forming, there's a very high probability that price can continue pushing down, right? So let's say we have a bullish candle at this point, and then boom, we have a resistance formed. Now we have a resistance form. Now let's suppose this is a 30-minute time frame or a 1-hour time frame. 15-minute may be a little bit tricky, because as we all know, the 15-minute time frame conformations are weak conformations. 30-minute and 1 hour are strong conformations. So let's say, price was coming down, we made support, came up, and now we're creating resistance to possibly continue pushing down. Now, in this case, let's say you're looking at this, you got all the conformations, and let's say you also have this range, and this is a 35 pip range, and you're like, okay, you know what, I can probably take a sell over here, and I can have a very, very good trade at this point. And you're going to say, okay, you know what, I'm going to take a sell right here. So you're going to take a sell, and this is going to be static risk. So if you're using static risk, you're maybe using your full 1% trade, or you may be using your full 2% trade, and you're taking a sell, and your stop is obviously above the candle, right? Your stop loss is always above the previous candle. You're taking a sell, and you're anticipating price to go down. With your full 2% risk, price goes down, you make some profits, you close the trade, you're like, perfect, I use static risk, and price went in my favor. Now, remember this is very, very, very important. Whenever you're trying to use stop losses, your stops always have to go above the previous candle if you're taking a sell, and it has to go below the previous candle if you're taking a buy. So it's not about how big your stop loss is, it's not about where your stop loss is, it's all about where your stop loss is, not about how big your stop loss is. Like sometimes what guys do is, like, you're going to trade gold or you're going to trade pound yen, and you're going to turn around and say, oh man, you know what, I have a very aggressive stop loss. That's just not going to fly over here, right? If you're looking at 30-minute time frame, you're looking at a 1-hour time frame, you have to make sure your stops are above the previous candle if you're taking a sell, and your stops are below the previous candle if you're taking a buy. Because take a look at this. If this candle has to go down, it has to respect the high of the previous candle, and that's where your stop is going to go. It has to respect the high. I can't stress this enough. It has to respect the high of the previous candle if it has to go down. So that's where your stop is going to go. If for some reason price does not go down, and price, let's say, starts to move up from this point, what are you going to lose, right? If we break above this high, what are you going to lose? How much percentage is it that you're going to lose? You're going to lose 2%, because you have static risk, right? You have static risk, so you're going to lose 2% of whatever you risked, okay? That's static risk. Now, let's talk about dynamic risk, which is very, very important here. And usually I use dynamic risk when Like, when I'm not too sure about certain moves, so I'm going to use dynamic risk. Static risk, most times I use static risk because I can manage risk. And we're going to talk about managing risk in the third section on static risk. So now dynamic risk. Dynamic risk, let's say you have, or you want to risk 2%. You're risking 2% and you're going to say, okay, you know what I'm going to do? I'm going to break this 2%, my risk, down into two positions. So you're going to break this down into 1% and 1%. That's what you're going to do. You're going to break this down into 1%, 1%, and now you have two positions. The first position, you're going to say, okay, you know what? I'm going to take the first position. Now, these are all hypothetical situations, right? Candle can move up to make a wick, or candle can move down, right? So what happens in this point is that you're taking a sell as soon as the candle starts. So this is where your first position goes, 1%. You're using dynamic risk. Now, if price goes up, this is where your stop loss. Now, if price hits your stop, how much are you losing at this point out of your 2%? You're losing 1%, okay? Because maybe you're not sure about this position, you're a new trader, this is a setup that you've been watching for a long time and you're executing on this for the first time, so you're being very cautious of the risk you're taking. So if price hits your stop, you're losing 1%. Now, there are different variations. Sometimes what guys tend to do is that as price retraces, they will add another position, and this is going to be another 1%. They're going to add a position, right? And the stop is going to be at the exact same place. Now, what's the difference between the first position stop loss and the second position stop loss? The first position stop loss is wider, right? The second position stop loss is smaller at this point, but now you have an opportunity to get a better price for this potential sell, right? Now, let's say price goes up, it does not break the high, it respects the high and starts to go down. Now you're in the money. At this point, you're in the money. How many people have, executed on candles that have been moving up, and you're anticipating the candle to make a top wick? And you're anticipating the candle to make a top wick, and then price starts to go down in your favor. You're like, oh yeah, isn't that a great feeling? When price starts to go in your favor at this point, without breaking the high, so we respect the high, you took your second entry right here, price moved in profits, and you're like, okay, you know what? Perfect, I won the trade, awesome. Right? Now, the second scenario here. Second scenario that happens at this point is going to be, let's say you have taken a sell, right? And this sell is the dynamic risk that you've taken just as soon as this candle opens, so you took 1%. Now, price retraced, right? Price retraced, and you're like, okay, you know what? Price is retracing. I don't want to enter a position as price is retracing because I find it very, very risky, because if I enter a position and price hits my stop loss, I'm going to lose 2%. So if it hits my stop loss, I'm okay with losing 1%. The number one rule of managing risk is to always be okay with how much you're going to lose. That's the number one rule. Write it down. I'm going to wait. Write it down. Always be okay with how much you are going to lose. Accept that fate that you're going to lose that much, right? So if price retraces, it's going to hit your stop, you're going to lose 1%, so you're not going to enter a second position. What you're going to do is, what I like to do most times is that if I'm going to go for a dynamic risk, as price starts to come back down and start to form bearish, I'm going to enter another position right over here. My second 1%. Because what I'm doing is I'm anticipating that if a candle has a top wick and a bottom wick, right? If a candle has a top wick and a bottom wick, and if price is breaking its own low and trying to go bearish, I'm anticipating that, okay, maybe the candle has made that liquidity wick. Now, some questions may happen that, should this happen in the first minute or the first 2 minutes or the first 3 minutes, 5 minutes? That's besides the point. We're not going to talk about that. When a candle moves in the first minute, 2 minutes, that's basically how many times have you seen that happen. That comes with experience. It comes with intuition, whether you're going to enter in the first minute, 2 minutes, 3 minutes. Over here, we're only going to talk about very simple stuff, and that simple stuff is going to be, let's say, for example, that the first half of this candle made the top wick. Right? And if it starts to go down in the second half, Now I'm anticipating that, okay, maybe the first half made a top wick, and now in the second half, we're trying to go down, and that's where I'm going to enter the second position. Right now, if let's say that I want some extra confirmation, maybe this is what I'm going to do. And this is what I usually do as well. If I want some extra confirmation, and some of you already have that answer in your mind, it's going to be once this candle starts to break the low of this previous candle, second position will go right over here. And guess where the stop is going to go? The stop is not going to go above the previous candle. The stop is going to go above this current candle. And then you can trail your previous stop above this current candle as well. Because guess what? If we're breaking the low, then there's no reason for price to come up and break its own high. Because if price is making a lower high, which is lower than the previous candle, and it's breaking the low to make a lower low, where are we going? We're going down. Okay? So that's what I'm doing. Dynamic risk. We talked about two situations, dynamic risk. First, you enter at this point. Second, you enter as price retraces, but that depends on confidence. The second one, you enter as we try to go bearish, or, sorry, we talked about 3-1, or you enter once we break the low. I find in dynamic risk, what's more useful is that you enter when the candle starts, and then, you know, the second position, if you really want to take a second position, you take that position as the candle breaks the low of the previous candle. That's what you do. That's what I've seen that has worked for me as well. And I've seen, like, you know, a lot of people have done that as well in our group, Slack group, YouTube, whatever. Now, let's say you're entering your 1% at this point. First position goes right here. And now you're going to say, okay, you know what, I'm going to enter the second position as price retraces, but instead of retracing, we create a tiny wick, and then price starts to break the low. In the first minute, or 2 minutes, 3 minutes, whatever, price starts to break the low, and you're like, oh, we're breaking the low. I don't know if it's breaking the low to retrace up. If it retraces up, that's a whole other thing, right? So we're not going to discuss that. If price breaks the low and starts to go down, now you only have 1% running, and you're like, oh, okay, you know what? I had no chance to enter the second position. Now, that has happened to me a lot sometimes too, where I basically had no chance of where to enter the second position. You know, so you got to take it how market gives it to you. That's the bottom line, right? Now, for example, instead of using two positions, you're going to say, okay, you know what? I'm going to be a little bit more risk averse, and what I'm going to do is I'm going to break this down into 4 0.5 lots, right? 1, 2, 3, 4. I'm going to break this down into 4 0.5 lots, right? So you can basically do the same thing. You can enter the first one right here, 0.5 lot, price retraces. There goes the second one, 0.5 lot. Your stops are right up over here above the previous candle. If candle retraces further more, you're going to lose 1%. You know, you're not losing much. You're just getting better prices, right? If price starts to break the low of the previous candle, there we go. You can enter another 0.5, or you can enter 2 0.5s, or you can enter, you know, a full 1%, making your total risk up to 2%. Go over the section again, right? Making your risk up to total 1%. So there are different variations how you can use your dynamic risk. And dynamic risk is very, very, very powerful because, you know, it teaches you the idea of managing risk. It teaches you the idea of how to average in positions as price goes in your profits or price goes in your direction as it's moving. And the same thing applies for if it's the opposite way, right? If price is moving bullish at this point. But always remember, as we talked about in some sections, that when you're trying to sell resistance, you're only selling resistance when we are in a downtrend. And you're only buying support if we are in an uptrend. Very, very important concepts, right? Very important concepts. Now, the third part, most important part, how to manage risk. How to make sure that you lose less than what you anticipated to lose. This has kept me out of trouble so many times. Like a lot of people, they see the streams, they see the history, they see the results, and they're like, man, how can you lose so less? How are you able to lose so less? And let me tell you this right now. It's not all the time you're going to be able to manage risk. It's not all the time that you're going to be able to close 50% or close 60% or close partials as candle highs get broken or the lows get broken. It's not going to happen all the time. There's a probability. Sometimes as price goes against you, you will lose the entire percentage, right? But most times you're going to have opportunities to manage risk. Sometimes you're not going to have opportunities, and that's just the odds of trading, right? But most times, I stress this again, most times you will have an opportunity to cut your losses short. So together, let's take a look at this right here. Now, let's say, for example, price is at a support, right? Price is at a support and we're going bullish. We're in an uptrend, and price, if it wants to go up, it needs to create a support. And you're looking at, the high created up over here, and this candle, basically, we came down, and you're looking at a support to be formed, and boom, you have a support formed. This is your high at this point, and let's say that this range is about 40 pips, because this is a pound, yen, or gold, or whatever pair this is, right? You have a 40 pip range, trend is up, and we've created a support. Now, we've created a support. Now, let's say this is a 30-minute time frame, so we're going to mark this down right here, right? So this is a 30-minute time frame, and now you're saying that, okay, there's a high probability for the next 30-minute candle to continue pushing up. So what are you going to do, right? Let's say, for example, that we're going to use static risk. Managing risk is always good when you're using static risk. When you're using dynamic risk, your risk is already managed. There's no, further managing risk on a dynamic risk. You're basically over-managing risk. And trust me, that's a term. When you over-manage risk, that's a term. Like a lot of you guys were watching this again from Market Fluidity. I understand that some people over-managed risk, and that's not good. Don't over-manage risk, right? Only do it like once or twice. So let's say static risk. So you're going to say, okay, you know what? I'm going to enter a buy right over here, right? You're going to enter a buy. And this is going to be, let's say, 1%. You're risking a total of 1%, and you're going to take a buy at this point. And obviously, your stop is below the previous 30-minute candle. And now you're anticipating this candle to respect this low and then to continue pushing up. If it continues to push up with respecting the previous low, awesome. You got a winning trade, you got full 1%. Now, let's say, for example, now we're going to break down this 30-minute into 15-minute candles. Let me do this. So let's do this. I'm trying to see where we have clean area. Okay, let's do this right here. So let's say, for example, that this 30-minute candle represents two 15-minute candles that look like this, right? You got two 15-minute candles. Oh, made a mess about it. So you got two 15-minute candles that look like this, okay? Now, you have the new 30-minute candle starting now, which means that you're trying to take a buy on the next 15-minute candle. So you take a buy right over here, and that denotes a 30-minute candle right over here. You've taken a buy, and this is where the candle starts. Now, if this 30-minute candle respects the previous 30-minute candle's low, your trade is still valid, and then, price can go up. What this means for the 15-minute candle is that if this 15-minute candle starts to go bearish and it closes bearish, now there are two variations, right? Remember, if it closes bearish, you have to close 50%. So from here, we're going to close 50% of the trade. If you had let's say a 1 lot running, you're going to close 0.5 lot. If a 15-minute candle closes bearish, and I'm going to tell you why. The reason why is that if the 15-minute candle has closed bearish, then there's a probability maybe the next 15-minute candle can continue to go down. And if the next 15-minute candle continues to go down without you closing 50%, now you're going to lose your entire position. Okay? Because if price has to go down, you have to remember, don't let your complete position go in a drawdown. The idea of managing risk is to never let your full position hit a stop loss. That's the whole idea. So the first variation is when the 15-minute candle is closing bearish, boom, 50% off the table. No matter what, 50% off the table when a 15-minute candle closes bearish. Now, if, let's say for example, the 15-minute candle does not close bearish, and if the 15-minute candle breaks the low, right, let's say that this candle is still open, breaks the low of the previous candle, this one, boom, 50% off the table, 100%. Because if it's breaking the low and respecting the high, what are we doing? We're making a short downtrend at this point, right? If the 15-minute candle respects the high and breaks this low, 50% off the table, 100%. You're taking 50% off the table. You're not giving market a chance to take your complete stop out. That's the deal right here. Because if it has to go up, it has to respect the dynamics on the smaller time frame as well for buys, right? If it has to go up, the 15-minute candle has to respect this low and then continue to push up, and overall making the 30-minute candle go up as well. It has to respect the low. 100%. It has to respect the low. Now, there's a question that may be coming up, and that question would be, oh, but what if a 15-minute candle closes bearish, okay, and we close 50%, and obviously this first 15-minute candle is the half of the 30-minute candle, right? What if the second 15-minute candle starts to go up and then continues to go up on the second one? Then what are you going to do? Well, in that case, you're going to be using the concepts we talked about in how to give your trade a second chance. Or you're going to use the concept we talked about, adding positions to a winning trade. Now, if it does start to go up, that means that maybe the first half of the 30-minute candle wicked down and the second half started to go up. But honestly, I've seen this happen very rarely, very rarely that we've had a bearish 15-minute candle and then the next one has gone up. It does happen very, very rarely, but it does happen, but also at the same time, it's also very important to be risk averse, right? You have to mitigate risk. It's very, very, very important. So whenever I'm using static risk and I'm looking at the 30-minute time frames, if the 15-minute candles break the previous low, I'm taking 50% off the table. Right? If I'm taking a sell on the 30-minute time frame and the 15-minute candles are breaking the high of the previous 15-minute candle, I'm taking 50% off the table. If we do continue to go in our direction where we thought price was going to go, then either I'm going to let whatever's left is run, or if there's an opportunity, I'm going to add that risk back to the trade. And that's what we've talked about in another section here as well that you can look into. Okay, when we're using dynamic risk, there's basically when you're using dynamic risk, you can't really manage risk because from the get-go, you've already managed risk on that dynamic risk. Because if you're using, let's say, total one lots right here, so dynamic risk would basically mean that let's say you're breaking this down into one 0.5 and another 0.5, right? So you're taking 0.5 right here, and you're taking 0.5 right here as a new 15-minute candle is forming. That's basically managed risk there anyway, because your total risk is one lot, and you have a 0.5 open, and you're basically entering the second position based on what we talked about earlier, right? So dynamic risk is perfectly fine. Whenever you're using static risk, that's when you're managing risk. Right, now, risk management, it takes practice, it takes time. Don't assume that you're going to get really good at managing risks. It's going to take time. It's going to take time to accept losses. The biggest problem people have is to really accept your losses. If you're not going to be able to accept your losses, you're going to overtrade, you're going to over-risk, and you're just going to compound your losses. Man, trust me, if you have a solid trading plan, right? And your trading plan says that you're only going to risk 2% or 1%, and you're going to manage risk on those trades, your trading plan is going to be rock solid. Your trading is going to be amazing. You're going to have a higher confidence. Your ego is going to be up. You're going to be more confident in executing trades, knowing that you can manage risk. And also, another thing, right? And this happens to all of us. Whenever we increase our lot sizes, guys say, oh, you know what, I'm super scared, I'm super anxious to increase the lot sizes. Raja, you have any tip? The biggest tip is this. Whenever you're increasing your lot sizes, just understand that you can manage risk. If you're going up from a 50-cent lot to a 1 lot, and you're kind of like scared at that point, just know this, that what's the worst that's going to happen on a 1 lot, right? If your stop is, let's say, 12 pips, for sake of simplicity, 12 pip stop loss, 1 lot, you may lose $120. But if you know how to manage risk, you may lose $80, right? You may lose $70. So that's a win in itself. If you're defeating your risk and you're losing less than what you planned on losing, that's perfect. And before we end this, understand this very, very carefully, right? In the start, it's very normal for you to focus on wins. It's very normal for you to focus on making the most amount of money, the biggest trades, and the best trades. That's perfectly fine. But what happens in the beginning? Everyone starts to lose money. So what are you going to do at this point if you start to lose money? Are you still going to focus on making great trades and great wins and lots of money, and you're going to keep overtraining, over-risking? No. The only thing you're going to do is to focus on how to stop the bleeding. And bleeding here means you losing money in the markets. You can't do that. That's the first thing you need to focus on. And honestly, in the beginning, when I first started, if someone would have told me, hey, Raja, listen, what you got to focus on first is how to manage risk. And what we did in the beginning was to how to make the most money, how to compound the most money, how to keep compounding and making these millions and gazillions, hundreds of thousands of dollars. No, it all came down to now. What I know now, if I knew this back then, my trading journey, very easy, very quick, very robust. You know, because in the beginning, we have to focus on manage risk. Take pride that you can manage risk. Whenever I lose a trade, I take pride in that, because my loss of a trade, it determines that, hey, you know what? I wanted to lose 2%, but I lost 1%, or I lost 1.5%. So in a way, that's also a win for me, right? Now, watch this virtual class again, and there's some things that you really have to incorporate in your trading. If you don't incorporate these techniques in trading, these even psychological techniques, that it's okay to lose, but lose less, aim to lose less, even ending the day with losing less than you planned is a winning day in itself, trading will be very easy for you, very simple. There are a lot of people in our groups here that do the same. They lose less, they have a strong command on their risk management that they can lose less. And that's where you win more. Because at the end of the day, you cannot control the amount of money you're going to win. Because price is just going to go where it wants to go. You can't control that. But what you can control is what you're going to lose in the markets. Take care.